Hi, good morning. My name is Justin Dye. I'm chairman and CEO of Schwazze, the largest vertically integrated cannabis company in Colorado. Glad to be with you here today.
Justin, well, thanks for joining us. I thought I'd take the opportunity to speak to you because we were involved with the cannabis space, investing in the cannabis space back in the day, heady days of 2017, 18, I suspect it was. But it was a meteoric rise. People made a lot of money, and then it fell away as quickly as it came, and people lost a bit of money. So there's kind of some mixed perceptions about the cannabis space and what's going on out there at the moment. So we're going to talk today about Schwarz, and you're going to perhaps help us with what's going on in the industry too. So thank you very much for that. Schwarz, what does that mean?
Schwazze is a technical term that actually facilitates growth of a cannabis plant. So it's actually the defanning of plants during the growth cycle to basically get rid of the leaf structure, so the actual stem and the root system can actually grow, broaden, and get more nutrients to what we're trying to arrive at and drive the flower development. So it's absolutely about growth and good, strong growth with bringing great nutrients to produce the highest quality flower.
Okay. So optimizing the bud size. Is that roughly rough translation? Okay, good. I'm there. Okay. Look, I think people have got perceptions about the cannabis space as being a little bit of the Wild West. It was a very nascent industry back in the day. Say, meteoric rise, meteoric fall. People are maybe a little bit nervous about getting back into that. There's other things that they should be looking at. What on earth has brought you to this point? Why have you decided I need to invest in and build up a cannabis business?
I think that's probably a gentle term to talk about the wild, wild west of cannabis several years ago. But actually, what's taken place now is the professionalism of a very large industry that's that will be equal to, if not larger than, the wine business or the spirits business down the road. And, much like our predecessors in the early 1900s, when alcohol was in its prohibition stage with the Volstead Act, we're in the same position. So we're very close, I believe, for the reins to come off on prohibition and for cannabis to be legal in a vast majority of the states. So we're very excited about that. And if you look at it, cannabis does a lot of good for people, whether it be for arthritis, whether it is for headaches, whether it's to treat cancer and other different ailments, whether it be joint pain or anxiety, etc., or simply for social means and picking an occasion to go watch a movie, to go out and watch a live show, etc. So it's proving to be an important part of the U.S. life, and you're seeing a lot of folks coming into the category from a consumer perspective. We're starting to see more women coming into what's historically been more of a male dominated category. So we're in our early stages of development, but it's incredibly exciting. We love Colorado. Colorado's got very stringent rules and regulations about legal growth versus the illegal market. So it's very easy to do business here. And we happen to be sitting here in Denver, and it's the second largest cannabis market in the country.
Okay, well, look, I do want to come on to all of the upside, the benefits that it has. But like I say, I just want to I need a building block from which to grow my investment thesis. And it's when we've had companies come on this show and talk about cannabis and they're where they want to position themselves in the cannabis market, whether it be medicinal or other or adult or recreational, the teams are young, they're very enthusiastic, they've got lots of ideas about how business works, but no experience, no capital, and that kind of business acumen that I would look for as an investor just isn't there. So, what makes your team so special?
Yes, and certainly there are individuals in the industry that have great perspective on products and terpenes and THC content and how the flower is grown and where it was grown and what sort of phenotypes and strains it came from. So you have individuals that have, really great perspective on that. I think, coupling that with individuals who know how to develop strategy, who know how to develop a vision around building a company, building blueprints on how you want to run retail dispensary stores and what good looks like and what consistency looks like 7 days a week, 365 days. Bringing disciplines around how you buy products and what quality of products you source, and making sure they're the highest quality and they're taken very, very well care of as they're being developed. I think those things matter. Bringing a team in that's got great financial discipline. So understanding what your costs are, understanding what your overhead costs are, understanding how to budget that, understanding how to get operating leverage. Once you start growing more and more retail and more revenue on a fixed cost basis, and being able to do that. And then obviously being good stewards of capital, putting capital in places that are going to create competitive advantage for you over the long haul, and that are good bets, frankly. So I think those types of things really matter in terms of developing what we're trying to develop here, and that is the most admired cannabis company in Colorado. So bringing that discipline, bringing professionalism, and what we call, really what we call our Schwazze blueprint is the way we're professionalizing our business and hoping to do that for the industry.
Okay, great in theory, but where's the experience come from? Where's that knowledge come from? What have you done in the past?
Yeah, so it starts with our team. It starts with me. My background, I started my career doing process and technology consulting and strategy consulting at Arthur Andersen. I moved into General Electric, where I did strategy, mergers and acquisitions for the aircraft engines business, which is effectively their aerospace business, for several years. So how to think about markets, how to think about profit pools, how to think about supply chains, and then how to go run a business. So I ran a business for them in Hamburg, Germany, that was very successful, and where we tackled both growth and efficiency in our manufacturing operations and distribution. So being able to have your hands on data, being able to make good decisions around that. And then I went on to working at a private equity shop in New York, where we took a very large food retailer who was vertically integrated. We took them private, Albertsons Companies, in 2006, and we grew that business. Once we restructured it, fixed it, we grew that business from $3 billion to over $60 billion in revenue, and from $75 million of EBITDA to $3.5 billion of EBITDA over about an 11-year period of time. So we, and that many of those team members are here with me that I recruited over. So being very good at retail, being very good at manufacturing, being very good at distribution, being very good at category management, being very good at technology, and having an integrated ERP system where you've got complete visibility and control over the business and understand what's happening. I think those are the foundations needed to compete, not only today, but into the future.
So when did you join this business?
I became CEO December 2019.
Okay, and have you put money into it?
I have. So our group has got close to $45 million invested in this business. So we are committed to it. We believe in it.
So your group, you and I guess friends and family, or however it's structured, you put $45 million into this. Okay, that's commitment. I do want to talk about some of those skill sets you just mentioned in terms of, especially the retail component with Albertson. That's truly fascinating to me, because that's a big, important part of this route to market. But let's just finish let's continue talking about the team here, because the other big hurdle in cannabis has been legal, regulatory, cross-state, cross-county borders in the US, and that's where you are. So how are you managing that?
Yeah, so let's talk about our staff and who we've recruited. So when I came on board, we basically started the clock again, and we went out and really cleaned the slate and brought in people that we knew we wanted and sort of what the objective was. So let's go first and foremost. We've got a terrific chief operating officer, Naroop Krishnamurthy. Narup has been a partner at Dye Capital, so he's got good private equity experience in fixing things and has worked with me there. He was the chief restructuring officer at A&P and took a ton of cost out of that system as they brought him in to try to save that in the bankruptcy process. That's actually where I met him and was incredibly impressed with his capabilities, knowledge, experience. He's a PhD in decision sciences, so he is a very, very smart guy. And not only that, has applied it to many other areas. He was also the chief information officer for United and helped restructure United after 9/11. So, very consistent, has seen big, difficult situations, has got a great operating background on how to drive retail, how to drive supply chain, and how to get the team to buy into what we're doing and get along and pull the same direction, which is awfully important. The next person is Todd Williams. Todd was with me at Albertsons. He ran corporate development and M&A at Albertsons and really was key in growing that business from 192 stores to 2,300 stores. And we did a number of acquisitions. And we underwrote the acquisitions. We had a synergy office and an integration office that he was involved with. And, I'll give you one example. Safeway, which was a large acquisition for us where we were nearly doubling the business, we committed $825 million of annual synergies that would accrete to the bottom line. And the team delivered a billion. So, the ability to put your money where your mouth is and go deliver really tough things, this team's done that. And the next is Nancy Huber, our CFO. She has been a CFO in CPG areas, tech companies, has been a public CFO, brings a lot of integrity and calmness and how to get things done, making sure accounting's right. She's put in a budgeting process, so we're very disciplined around that, doing zero-based budgeting, and has done a nice job with really standing up our financial infrastructure, FP&A, and the other things that we need to do. And she's got an engineering degree from Purdue, very smart, and has an MBA from Northwestern Kellogg School of Business, which is a top 5 MBA program. So Nancy's been a key at. And then on my executive staff, the last person is Dan Pabon. Dan serves as our general counsel and head of government affairs. Dan is a very talented guy that we handpicked a couple of years ago. He was actually the guy that put the rules in place in Colorado on how to regulate cannabis. So he was on the House of Representatives and was asked to lead that. So he's put in a great set of rules. Those have adapted over time, and he's consulted all over the country and all over the world on how to set up cannabis regulation. So Dan, one, is very incredibly smart, knows every nuance of the regs, as well as has great relationships here within the state with the governor, with the mayor of Denver, with local jurisdictions all over the state, and is well thought of in Washington, D.C. as well. So that's sort of the senior team. And then below that team, we've got, we recruited a gentleman to run data sciences for us so we can look at consumer behavior, path to purchase. He ran global data sciences for Under Armour. So we've got a very good team there. We have our individual that's running retail for us, Colin Lodge. Colin has a great retail background. He came from Albertsons and did M&A, did corporate development, helped ran a food delivery business for us, and has been here with us for a couple of years. Colin knows our playbook, knows what our retail blueprint is, and has done a fabulous job. And then we have other Jim Parco, who was acquired. Okay.
Yeah, I get it. You're not messing around with the team. That's what I'm hearing. You've gone for the A team, or as an analogy people use, you built a Rolls Royce, but at the moment you're like a Prius. You're 100 million market cap. So why did you feel the need to spend that money to get that team in now, and not just something that was fit for purpose for where you're at in the process? Help me with this, because you've taken a $3 billion company to $60 billion. you know what you're doing. I just want you to share that with me now about what are the parallels with what you did then versus what you're trying to do here, because that team is serious.
Well, we've got, I mean, yes, it's serious, but we have a serious mandate. I mean, the opportunity here is to build $1 billion business. And all of these people came in with, they took salary cuts, and they wanted to buy into this system. They wanted to buy into what we were doing, sort of the Schwazze blueprint. And they're going to have upside with being an owner in this business. So they've really bought into what we want to do, and we want to go fast. So for us to go fast, I need an outsized team in terms of capabilities to go do that. And I think speed is absolutely critical. I think speed will be our competitive advantage as we go out, identify, underwrite, close deals, and then integrate them, and then rip the synergies out of them and make sure we're delivering. So that's why we sized it the way we wanted to. And by the way, when you look at how we're running this from a lean perspective, I would put our headquarter costs as a percentage of sales to anybody in the industry. We still run very, very lean, and people are very talented, and they do multiple jobs.
Okay. The Colorado, well, I'm looking at some numbers you've actually provided in your PowerPoint, which is the US cannabis revenue estimated by 2022 to be $2.5 billion. Colorado alone, okay, which is where you operate today. So you're talking about being $1 billion company. So let's break that down. Let's start from the beginning. So how do you get to $1 billion company in Colorado, or are the ambitions bigger than that?
Yeah, the ambitions are bigger than that. Our ambition is to build a $500 to $600 million business in Colorado. The blueprint that we've developed here, that we continue to perfect, is something that we will apply to the next state and perhaps to the next state. So we very much would love to become our ambitions to become a super regional, where you're in a geographic area where you can share best practices. Granted, the supply chains all have to be separated and reside within their own respective state. However, people will travel. We can move people around. We can move store directors. We can move general managers around. We can move people that are running manufacturing plants, cultivations, and move them around in a geographic area. So we can continue to really manage our culture and make sure we don't deviate from that culture and what we stand for and how we want to go compete and win. So that's where we're headed. When you look at the vision that we all signed up for, the vision of this company is to be the most admired company in Colorado in the markets where we participate. We do that by going very, very deep in the state. What do I mean by deep? Deep and broad. We want retail. We're going to lead with retail stores in every corner of Colorado. Western slope, western side, northwest, northeast, southeast, southwest, Denver metro, all the way up through the I-25 corridor. We have tons of growth to continue to roll out stores there. And we're going to continue to do that. And the way we get there is we've got a great ground game with our real estate personnel going out, building relationships with commissioners and town councils and mayors and all through the state with the government, and finding new licenses, finding new stores, acquiring independents that may be running 1 or 2 stores that are tired of the 24/7 retail experience, because retail is hard. Retail is particularly hard for a small operator. And, it's hard to keep up with companies that have size, scale, and can continue to bring talent in, rotate talent out, and can outspend you. So that's really what we're doing in Colorado. And we'll end up building that shelf space throughout the state. And we will then, it's a part of that shelf space, we're going to be in a position to bring our own flower in, which is a much higher volume or much higher margin. We're going to be able to bring in our store brands or our own branded products, whether it be pre-rolls, concentrates, salves, flour, etc., and bring that into our stores and build loyalty, build a reputation of quality and availability, and build those brands. And then we'll take those and probably go a more premium product, and then we'll be able to sell to the other independents. So that's that's sort of the sequencing of the blueprint. Establish retail, sell our own flower, sell our own brands, and then build premium brands that we can sell into other folks.
Okay, so a few things going on there, which I want to talk about, which is basically your business model. So I get that you've come from a retail background, with Albertsons and Cerberus. What if when we back in 2000 when internet came along and they go, oh, bricks and mortar are dead, and then for some sectors it was true for a while, and we've seen that again through this kind of COVID period, people going online in their droves and buying stuff online. You're talking about going out and getting properties. You've got to brand those things. You've got to kit them out. You've got to staff them. You've got to pay your rent and all the other kind of ongoing costs associated with that. Why is that the kind of cornerstone strategy for something like this, which surely is going to be much more easily distributed online? You can build up an online presence and do this. Why is physical retail important to you?
Yeah, two comments. One is we want to be able to meet the customer where they want to be met. Occasions dictate how people shop. We've seen that in food retail. We've seen that in other sectors as well. So, there's a time when, mom or dad of the household wants to go to a store and pick out some variety for Friday night. They may want to they're having friends over and they want to pick out a new strain of flower or a concentrate or a gummy or an edible or a pre-roll. There are also times when they want it delivered and they don't have the time to go do that. Or, you have someone who's kind of curious, but not super comfortable coming into the store just yet as they're going down their path with getting to know cannabis. So it's safer to have that delivered. So the way it works is we will have a network of brick and mortar stores. We also have an omni-channel capability. So you can do curbside pickup, you can have same day delivery, next day delivery, and we're measuring the last mile with outside parties as well as our own trucks, our own employees. And we're doing some of that test and measure as we speak. So we are delivering today in Aurora. So we're watching the basket, we're watching the contents, we're looking at the consumer data, who's buying, why are they buying, what's the occasion, and learning a lot there. So,
oh, that's interesting.
And another thing, Matt, is the way we're set up in Colorado. A buyer must purchase from a brick and mortar store. And then it must be shipped from a brick and mortar store. So it's very much a part of the omni-channel ecosystem is having brick and mortar stores with same day delivery, next day delivery, and curbside pickup. So, that's an advantage for operators in Colorado. So you can't have someone come in with a cannabis sort of Amazon model where they're going to set up fulfillment centers and ship all over the state. So the anchor point of the retail ecosystem is the brick and mortar dispensary. So that's why we're putting a lot of muscle behind building a big, broad set of dispensary locations across the state.
Okay, so that's the kind of adult recreational. In fact, that's interesting, actually. You use the word recreational. Most people have, up until, the past few months have been talking about the word adult because recreational had a bad connotation or a negative connotation to it. But in America, everyone understands that. There's no negativity towards that.
Certain people do. We use it interchangeably. I'm happy to use adult use if you think that plays better. We talk about it either way.
And on the medicinal side, is that something that you'll get to, or is not part of your model or revenue projections?
We certainly see there are continuing to be medical only dispensaries, and we will add a few of those in certain geographies on a select basis where those geographies only allow medical cannabis. But in general, the market, once you have adult use, the market swings pretty dramatically over to the recreational side. And on the medical side, you can buy more, you can buy bigger quantities of THC without any taxes. But in general, what you see is a migration from med to rec over time.
And is that partly because the difficulties are operating in that space? Is it medical, pharmaceutical, very heavily regulated? The distribution channels and the players involved do control large swathes of your ability or a company's ability to make margin. So is that part of the consideration, or is it just more that you see the future of this market?
I think for the consumer, certainly heavy users that are treating cancer, pain, back pain, arthritis, etc. You're going to continue to see them probably buying medical grade cannabis, so they just get more THC. So when you think about that, that's going to continue to be the place. But you're going to have to, but to do that, you've got to get a medical card, and you got to continue to have that medical card from a doctor, continue to keep that refreshed. So it's just a little more inconvenient than simply walking in and buying cannabis on an adult basis.
Okay, so that's interesting. So I want to also go back to something you said earlier, which is you will grow your own, right? Now, if I look at the industry, well, Albertsons would be a prime example of that. You would never have dreamed of owning a farm, I suspect. Would you?
We did not. We didn't own a farm, but you know what? We actually had 20 manufacturing facilities. We manufactured our own milk, our own ice cream, our own bread. And the margin profile of those products were substantially higher than buying it from CPG manufacturers. So you'll certainly see us do that as well. Our goal is to sell our own items in our store, but also source really high quality flower and products that give us great variety for our customers and what they want. So that's the secret sauce.
So just explain that a little bit for me, because if I look at supermarkets today, they have relationships, they have contracts and agreements with farmers, growers, and they're squeezing those margins down. And we get to hear a lot of very vocal farmers. I've never met a poor farmer, but they talk the language, and therefore. It seems like you've got a lot of growers out there who you'll be able to, option and get contracts in place with. So why wouldn't you do that instead? Why the desire to control it all the way from seed through to sale?
Yeah, so let me be clear on that. So once again, I come back to what our blueprint is. Our blueprint is to have broad set of stores that are high volume, that we have coverage to cover the consumer in Colorado, all corners. Western slope in the mountains in Denver. We want to be able to, today we source a majority of the flower that we sell at our stores today. So we have 17 stores today. We're going to 19 with the close of 2 in Boulder. And today that's all sourced on the outside. We have partnerships with well over 30 growers, high quality growers over the state. So if you think about it, let's just do some simple math. So if you look at the wholesale price today, it's approximately $1,200 per pound of grade, of sort of select grade, sort of middle tier flower. We can produce flower indoors between $400 and $500 a pound. Greenhouse, we can grow between 150 and call it 250 a pound. Outdoor, we can grow it for less than 100 a pound. So the variation in terms of what the cost structure is quite significant. So bringing that into your retail stores, obviously you've got margin expansion opportunities there. Now, you've also had to spend the CapEx for that farm, and you have the exposure for the crops, et cetera. So the way we think about it very simply is we want to hedge. We would like to have 50% of our flower capabilities within our own system. And then we're sourcing 50% of that with really good partners, good growers that are growing strains that we want and are working with us on innovation and for new strains, new terpene profiles, new THC levels, et cetera, to be able to do that from a genetic standpoint. And we think that's a great place to be, and then we'll evaluate that. But that's how we're thinking about it. Now, on the bio, let's switch gears. So that's retail. Now let's talk about our wholesale business. So we are the largest wholesaler of distillate in the state today. We have about a little over 20% of the market today. So we take trim and biomass, we bring that into our manufacturing facility at Purple Bees, and then we convert that with heat, pressure, solvents, and we distill it, and we create 90% plus distillate that we sell by the kilogram to manufacturers. So it's a B2B business. So we would sell that to vape cartridge manufacturers for the distillate. We would sell that to edible manufacturers as well, concentrate manufacturers. So we would sell that. Now, the input of that is biomass. So we would like to get to 60% of our own biomass needs to be able to supply that, because we can supply that much cheaper than going out and buying biomass on the wholesale market today. So you're very much a hedging strategy, very much what I deployed at Albertsons. So we didn't buy all of our, we didn't make all of our milk, we didn't make all of our ice cream, but we had a natural hedge against future price increases from the manufacturers, which is what they would do. So, and I think that's a great place to be. I haven't heard anybody else really thinking about that way, and I think our backgrounds lead us towards that strategy.
Right,
does that make sense?
Well, I've got a question, which is, I get the hedging component, but if I look at control is a great thing in business. You want to be in control. I get that. Okay, certainly given where you come from, but the kind of CapEx component, disease control component, and all the other risks that you're going to have to mitigate, control, and spend money doing when you're a $100 million company, that's the decision making which intrigues me and go, well, actually, do you know what? It's worth it because what? It's worth it. Why?
It's worth it. We have our own proprietary growing methodology called 3 Alight. So the beginnings of this business was really around consulting around cultivation. So we have master growers who, back in 15 and 16 could go in, stand up a new growing facility in Pennsylvania, in Nevada, in Arizona, and they could go stand up growing facilities where those facilities were struggling getting crops out, where we would come in and be able to give them what's called 3 pounds of light. So for every light, for indoor light, we would be able to take their yield up anywhere from 100% to 300%. So we have that capability within our ranks today. So that's preventative, maintenance of the equipment. It's looking at nutrient provisions. It's looking at the growth cycle. It's looking at humidity, all the controls around doing that, and managing disease and managing pests. And we've got a full process and a blueprint for doing that, and we feel very confident. We've got almost a decade of experience in doing that, and continue to refine that 3 Alight process. So that gives us great confidence. Okay,
so you got the experience and track record, but none of this is theory. None of this is new to you. Okay, get it. I'm going to kind of skip through.
We got about 10 decades of scars.
Yeah, it's the best way to learn. Okay, I want to kind of skip through a few topics here because I'm actually really, really intrigued by this. I wasn't expecting to like it. I do. So I want you to come back on and do a deep dive elsewhere. But and I was also conscious of time for both of our sakes at the moment. But I do want to finish off with your M&A strategy. You're quite acquisitive. Now I've referred to a lot of naive individuals coming in here who've got experience in one aspect of this, or belief that they can crack the market where others haven't, or they've got a product or some sort of strategy which will allow them to succeed where others haven't. And a lot of them have fallen over. But based on the numbers for Colorado, 2022, 2.5 billion. Actually, I'm looking at California, 4.7 billion, Florida, 2 billion. I mean, sort of circa $23 billion worth of cannabis revenues that you're talking to me about for 2022. It's getting to be a sizable market. The M&A strategy, you've got to make darn sure that you're picking up the right companies that give you some leverage or some advantage or some level of quick win, or you're going to waste a lot of money here. And I know you're doing that in an environment where regulatory, legal frameworks are difficult to navigate and therefore slightly more expensive to navigate. So what's the plan here? What do you do when you're a $100 million company versus what you'll do when you're a $1 billion company?
I think it absolutely starts with a systematic approach. So it starts with strategy. So what do we want to do? So we lay out, let me just walk you through what we're on a whiteboard. We're going to get a PowerPoint together. I'm going to let you into, here's how we do this. So we lay out the state. We lay out all the stores. We pull metric reports. We look at who's got volume and who's doing the most volume out of those dispensaries. We look at it versus our store footprint and where we need to continue to add, where we have opportunities to grow density and grow market share. We lay that out. We get a number of attractive, we believe from a volume perspective, we may not have all their financials and no profitability, but we have some proxy information. And then we rack and stack that and prioritize it, number of stores, location, et cetera. Ability for us to run our playbook there, which at the store level is great assortment, great quality, great customer service, and a really great experience when you come in. And can we deploy our system doing that? Can we get staff there to manage that particular store? So we look at that. And then we look at, okay, so if a chain has 20 stores, we have a group who goes and attacks that and looks at, we do the analysis, we look at it, we do an approach, we meet with that company, we talk about what the benefits of coming together could look like. Then we also have independence. And as I shared with you, of the north of 600 retail dispensaries focused on adult use, well north of 400 of those are single store operators or own two stores. So it is very fragmented. Then I have a head who has a team underneath them where we go out and we go meet with those independents. We go have lunch with them, we build relationships with them, and we develop rapport. And very quickly we say, okay, is this attractive to us? And then you got to say, okay, is this actionable? Are these folks really interested in selling or not? Because time and our health are our greatest assets. So we make a decision around that. Is this going to be a 18-month romancing, or is this going to be something that we can get traded in 2 to 3 months? Okay. And we put that in there and that goes into the funnel. And then we allocate resources. And then behind that, we have a underwriting team where we do quality of earnings. We make sure there's no legal issues. We look at all the liabilities. We've got a legal team that's got a standard purchase, whether it's an asset purchase agreement or stock purchase agreement. We try to come to terms around that, and very quickly, once we do that, once we sign off, the business is what it is. We look at synergies, how they're buying, what we're buying, where we think we can take best practices from them, et cetera. And then we turn that over we close. Then the integration team, about 6 weeks before we close, is putting together all the integration. So today we've integrated all 17 of our stores on the same point of sale. And we did that within 2.5 months, which is incredible. The team did a great job. And I brought somebody over who's done merger integration work at 2 other places, who's worked with me. So we have a system, we have analysts, they know data, they know people. We got to pay people right. We got to get pricing right. We got to convert the store, et cetera. So they've got a system in doing that. And then the back part of that is we've got a scorekeeping group. So we have a synergy realization office. And that group is run by our data science group, and we run it like a business. So we have a P&L. Here are all the synergies. So we said we're going to get X amount of growth synergies, margin synergies. Here's how many new products we're going to add to the store, and we're going to measure that. Here's our cost takeouts. Here's what we're going to do from electricity, from whatever. We put all that in and say, okay, here's the scorecard. Now let's see how we do. And we obviously want to underpromise and overdeliver, so we develop credibility around doing that. And that's that is the blueprint. Okay. And you got to have a team out working every jurisdiction, all corners of the state. We're working on probably 20 different cities right now, and that requires meeting the commissioners, meeting the mayor, and it is hard groundwork.
So it also requires money, though, Justin. So what?
I don't see anybody else doing that today.
No, I've certainly not heard of it either, but it will require money. So what are you going to do about that? Are you going to keep piling money in, or are you going to have to go out and raise?
I think we're going to have to continue. The way we structure our deals generally, we're buying companies anywhere from 2 to 3 times EBITDA, all the way up to 5 times EBITDA. We trade today, we're undervalued at 10 times. So these are accretive deals. They're all profitable. And then if with synergies, we can be able to buy them a little bit cheaper than doing that. But that's the way we're thinking about that. The way we structure our deal, which is what your question is, we typically will do cash. We'll typically take a seller note that is better than capital markets today, that gives us a little better cost of capital. And then we provide equity. And those range depending on what the negotiation is. So that cash component piece of it, we're sitting on, I think last quarter we announced we were sitting with $21 million of cash. We're generating free cash. So some of these acquisitions will be paid out of our balance sheet in cash flow generation, some of which are a little bit larger. We're going to need to raise some capital. The good news is cost of capital is coming down. The good news is with size and scale that we have, we're attracting more pools of capital. So there's actually competition and bidding friction when folks are looking at us, whether it be on equity or whether it be on a debt basis. So we have to raise capital. I think the markets are open for us. Our story is resonating. We're a contrarian. Our strategy is very different than the MSO, who wants to be in 30 states or 25 states. They want 2 or 3 stores in each state to say they've got coverage, and they've got, and they're building it that way. We're building it differently. We're building it from, our foundation is going to be retail, where we can grow market share. And that gives us the opportunity to build brands, to develop our flower brands, build a really great business. Then we can start launching premium brands within our stores, selling it within Colorado, and then whatever the next state is, the next state. That's how you build brands. And that's different than what other folks are thinking about, but that's a way to do this thing over the long haul. That's why we're different. That's why I think the strategy is one that's worth taking a look at.
No, it's definitely interesting from that perspective, and perhaps I keep threatening to wrap this up, but I keep thinking of other questions. Is you're on the OTCQX at the moment, right? Which is great, so people can get access to this. But bigger plans than that down the line, or is that again a constraint because of the legal and regulatory component of cannabis?
Yeah, Matt, great question. I mean, today because cannabis is a Schedule I drug at the federal level, as a U.S. operator of plant touching operations, we do not have access to the NASDAQ or the New York Stock Exchange. There are other exchanges outside of this country where we can, particularly in Canada. And that seems to be something that could be interesting and something that we could explore. Okay,
Justin, look, I will finish it there. Please come back on. There's a few rabbit holes I want to kind of dive down with you. I'm certainly intrigued about the branding component, the marketing component of this, especially around sort of adult recreational in Colorado. But I'm also intrigued about how you can leverage synergies cross-border, given again the constraints there. So appreciate your time today. Best of luck. Speak to you soon.
Thank you. Thanks for having us.